Mortgage rates peaked at 7.5% a couple of weeks ago and are staying stubbornly high. Rising mortgage rates means rising inventory as home buyer demand slows quickly. But home prices are staying pretty stable, even though we can measure a slowdown in the number of homes getting offers. Most years, inventory of unsold homes on the market peaks in August. This year, inventory is still climbing now in September. Last year at this time, if you recall, mortgage rates began to spike dramatically from under 6% to 7.5% in just a few weeks. And this caused inventory to rise dramatically late into October. The change in rates this year isn't as dramatic as the change last year, so the change in inventory isn't as dramatic either. Last year, the change in mortgage rates was rapid enough to drive home sales prices down as well. There's no getting around the fact that home sales are slow. Demand is held back because the cost of money is so much higher than it has been recently. It is notable that home sales prices are not really yet declining rapidly like they did last fall, but there are some hints, new hints of weakness in future home sales prices. These nuances change, and it's why Altos Research tracks every home for sale in the country every week. We track all the pricing, all the supply and demand, all the changes in that data so that you can understand immediately the changes in buyers and sellers and what they're having on the housing market. So we make that real estate data available to you before you see it in the traditional channels. I'm Mike Simonsen. I'm the founder of Altos Research, and let's take a look at the signals for early September 2023. So available inventory of unsold homes, single-family homes, rose more than 1% again this week to 509,000 homes. The supply of homes on the market does not appear yet to have reached its peak for 2023. Last year at this time, inventory actually had appeared to have peaked already in August, but the number of homes on the market jumped again starting in September, along with that jump in mortgage rates. So in this chart, you can see the comparison. The dark red line is this year on a steady climb each week. That's right now. Mortgage rates have been climbing, rising, and not falling back down, making homes more expensive to buyers and obviously slowing demand. Less demand means fewer purchases and therefore inventory builds. There are 8% fewer homes on the market now than last year at this time, though. And my guess is that later in September, mortgage rates, maybe if they ease down, maybe even under 7%, inventory will start declining for the rest of the year. Contrast this to last year, the light red line, when inventory kept climbing until rates finally peaked in November of last year. So in this chart, each line is the curve of the year's inventory of unsold single-family homes. Notice how each year the inventory generally peaks in August, and this is really an effective illustration of the impact of this year's higher mortgage rates and what they're having on buyer demand right now. Inventory could still keep building for 2 more months if mortgage rates jump again. But if they ease back down, inventory will be somewhere in the next few weeks before probably the end of September, hit its peak and start declining again for the end of the year. There are only 358,000 single-family homes in the contract pending stage right now. That's 11% fewer than last year. The rate of sales actually picked up a little bit this week before the Labor Day holiday, though home sales are still really running 7 to 10% below last year. This moment last year was right at that cusp of that dramatic slowdown, both in prices and in the purchase volume. So it could be that we finish September with home sales at a faster pace than last year. However, I've been looking for that change for several months, and it's been elusive. For a while this year, it seemed like home sales would finish 2023 stronger than in 2022, but that has not materialized. So maybe it's wishful thinking on my part, hoping the housing market will pick up. We saw 64,000 newly pending contracts this week for single-family homes, which is 7% fewer than last year. This week now is a holiday week, so the sales volume will tick down with next week's data. We have 11% fewer total contracts, but only 7% fewer new contracts this week. So it's just slightly closing the gap from last year. In this chart, each bar is a total number of contracts, of homes in contract. The taller the bar, the more sales that are in process in a given week. The light portion of the bar are the new contracts that week. Last year, the sales rate, the new contracts, slowed dramatically after mid-September. So see how the light portion of the bar shrinks each week during the end of last year. And this year, the slowdown is much more gradual, much more like normal seasonality. Meanwhile, this autumn's slowing home buyer demand is showing up in the price reductions data too. The percentage of homes on the market with price reductions, those houses that have taken a price cut, climbed again this week to 36.2%. You can see how we now have more price reductions than in any recent year except last year at this time. So think about price reductions as a leading indicator of future home sales prices. Tracking price reductions now is an excellent indicator of the organic levels of demand in the market. So a home on the market now, if it doesn't get offers, it does a price reduction in September, it gets an offer in October, which closes in November or December. And we can see right now those sales prices are starting to weaken, and it's several months in the future. This trend could change, like it did in the first half of this year when rates were falling again. But it seems to me that consumers are reacting more to changes in mortgage rates rather than specifically to the absolute level of rates, meaning when rates went from 7 to 7.5 last month, that's why we have more inventory and more price cuts now. When rates jump, fewer buyers make offers, therefore more sellers have to take a price cut to stimulate demand. That's what we're seeing right now from that jump in rates from 7 to 7.5% a month ago. Last year, almost 40% of the homes had taken a price cut right now because rates had jumped from 3% to 6 to 7.5% in the year. So we could see a dramatic slowdown, dramatic increase in inventory, and significantly more price reductions last year. And that was showing us greater weakness in future home sales prices than we see right now. In fact, home prices are running just slightly above last year at this time. The median price of single-family homes in the market, all the unsold homes, is $448,000 right now. Last year, those homes were priced at $440,000. So they were adjusting down very quickly at the second half of the year last year. We saw that in the last slide with those price reductions data too, where last year was significantly more, had price cuts. The median price of the newly listed homes this week, the newly listed ones, is $395,000. Now that the price of the newly listed cohort each week is also a leading indicator of future sales prices. So each week, sellers and listing agents, they have to price the new listings at a price point where they will sell. And last year, when demand was dropping quickly, so was the price of the new listings. If you were going to sell, you knew that demand had fallen quickly. So if you wanted demand for your home, you had to do a discount. And so that's the light red line here on this chart. Now at the far right end of the light red line, you could see that home prices are ticking down now, as happens in the third quarter each year, but they are not falling as quickly as they did last year. Even when rates both times were at 7.5%. Last year, the change was much more dramatic, so the change in prices was reacting much more dramatically. This year, it's only a 0.5% move, 50 basis point move, rather than a 350 basis point move. The median price of the homes in contract is $379,900 right now. That's unchanged from last week and about 1% higher than last year at this time. Over the last few weeks, those pending home sales prices have been ticking down. This is what you'd expect for late summer. So even though we can see the rate of transactions slowing, we can see the percent of homes with price reductions ticking up, the price of those getting offers isn't yet dropping really dramatically like it did at several points last year. And you can see that in this chart. Several points last year where we had big spike in rates and a very quick drop in the prices that people were willing to pay for homes. Right now, it's just easing down. And this really illustrates my point that home buyers are more sensitive to changes in the rates than they are to the absolute level of rates. This year, at the far right end of the chart, the dark red line, you can see those home sales prices, those pending prices, newly pending, peaked a couple of months ago and just before mortgage rates started climbing for the summer. And then you can see the gradual decline in the dark red line now. The median price of the homes newly in contract is $370,000 right now. That's basically unchanged from last week and unchanged from last year at this time also. Now, obviously, home buyers are sensitive to affordability. They're also sensitive to weekly changes in affordability. Last year, the changes in interest rates were huge. In a few short weeks, mortgage interest went from 6 to 7.5%. That translated into a big drop in the price of those newly contracted sales. And you could see that happened in that September dip of the chart, in the middle of the chart here on the dark red line. Buyers that still chose to buy would only do so at a significantly lower price point then. And so this year's mortgage rates increase have been much more gradual, and the subsequent price declines have also been much more gradual, even though rates at both times were at 7.5%. The home sales that are in the contract stage, they're in contract stage for 30 to 45 days commonly. So each week where the new sales prices tick down, that adds up over the few weeks to the total set of pendings. That's the light red line. So by the way, our September webinar is where we'll look at the deep details of all the data, both the active market and the pending, so you can see where sales prices and volumes will be in the future. We'll have the latest inventory forecast for the year and looks at the local markets as well. That webinar, the September webinar, is Thursday, September 21 at 10 a.m. Pacific. There's a link in the description below to join us to reserve your spot. We just announced that webinar today, and there are already almost 1,000 people registered. So you should join us too if you want to be able to communicate about the housing market with your buyers and sellers right now. There's so much signal in the active market that looking at the lagging closed sales prices don't tell you anything. So if you need to help buyers and sellers understand the housing market, help them make decisions, go to altosresearch.com, book a free consult with our team, and we will help you know how to talk about the market with your clients and your prospects today. There's a link in the description below. All right. See you next week.